Welcome back to our series on the 2008 financial crisis. In our last episode, we explored the lead-up to the crisis, focusing on the housing bubble, financial deregulation, and the rise of risky lending practices. We broke down how major financial institutions, like Lehman Brothers and Bear Stearns, collapsed under the weight of toxic mortgage-backed securities, triggering a meltdown across the global financial system. We also discussed the U.S. government's response through the $700 billion TARP bailout program, the Federal Reserve's drastic measures to stabilize the economy, and how this financial turmoil spread to economies around the world. While we've covered the financial mechanisms behind the crisis, the fallout didn't stop with the banks. In today's episode, we'll shift focus to the deeper economic and social consequences. We'll examine how the crisis devastated global economies, left millions unemployed, and caused massive home foreclosures. We'll also explore the human cost, how families were displaced, retirement savings wiped out, and inequality worsened. Then, we'll broaden our scope to see how the crisis rippled across international borders, destabilizing markets in Europe, Asia, and beyond. Finally, we'll wrap up by looking at the key lessons learned from the crisis and the major reforms that were introduced in its aftermath. From the Dodd-Frank Act in the U.S. to increased financial oversight globally, we'll discuss how governments and regulators aimed to prevent another collapse, and whether those reforms were enough. So, let's dive in as we explore the aftermath of the 2008 financial crisis and the lasting impact it had on economies, people, and the financial system itself. As the financial crisis rippled out from Wall Street, its impact was felt far beyond the banks and investment firms. What started as a meltdown in the financial sector quickly transformed into a full-blown global recession, with devastating consequences for economies around the world. In the US, the recession was especially brutal. Over 8 million jobs were lost as companies slashed their workforce in response to declining demand and shrinking profits. Entire industries, particularly construction, real estate, and manufacturing, were hit hard. Unemployment rates skyrocketed, peaking at over 10% by late 2009. This sharp rise in joblessness sent millions of American families into financial distress. With less income, consumer spending, one of the main engines of the U.S. economy, fell sharply, creating a vicious cycle where businesses had to cut back even more, leading to further layoffs. And it wasn't just jobs that disappeared, homeownership was deeply affected as well. The collapse of the housing bubble led to the worst foreclosure crisis in U.S. history. Millions of Americans lost their homes as property values plummeted and mortgage payments became impossible to keep up with. In some regions, entire neighborhoods were left blighted by vacant, foreclosed homes. This not only wiped out the wealth of many middle-class families, but also created lasting damage to communities across the country. Globally, the economic downturn was felt just as intensely. International trade and business investment took a massive hit as companies cut back, and countries entered recessions of their own. In Europe, many economies struggled as the crisis exposed weaknesses in the banking systems, leading to a wave of government bailouts similar to those in the U.S. Countries like Greece, Spain, and Ireland experienced deep recessions, with high unemployment rates and austerity measures sparking widespread protests and political upheaval. Meanwhile, housing markets across the world mirrored the crash in the U.S. Places like the U.K., Spain, and Ireland saw their housing booms turn into busts, as home prices cratered and construction projects were abandoned. These collapses had far-reaching consequences, from rising homelessness to massive declines in household wealth. In emerging markets, the impact was somewhat different but still painful. Countries that were heavily reliant on exports, like China and Brazil, saw demand for their goods plummet as the global economy contracted. While some of these nations managed to recover more quickly than the US and Europe, the initial shock was severe, leading to slower growth and rising unemployment. Overall, the 2008 financial crisis triggered one of the deepest global recessions since the Great Depression. governments and central banks around the world scrambled to prop up their economies with stimulus packages and financial support. But the road to recovery would be long and uneven. In the next segment, we'll focus on the human cost of the crisis, how individuals and families were affected by the financial collapse, and the long-lasting scars it left on communities and livelihoods. As the financial crisis tore through economies around the world, its impact went far beyond numbers on a balance sheet. For millions of people, the crisis was deeply personal, shattering their financial security, their homes, and their futures. In this segment, we'll dive into the human cost of the 2008 financial collapse, focusing on the social and psychological toll it took on individuals and families. One of the most visible consequences of the crisis was the dramatic rise in homelessness and joblessness. In the U.S. alone, over 8 million jobs were lost, leaving countless families struggling to make ends meet. The loss of stable employment created a ripple effect. When people lost their jobs, they also lost their ability to pay mortgages, rent, or even basic living expenses. This triggered an unprecedented wave of foreclosures. Millions of Americans lost their homes, either through foreclosure or because they could no longer afford the rent. Entire neighborhoods, once thriving, were now filled with vacant homes and empty lots, creating a haunting reminder of the collapse. For many, the financial stress of losing their job or home was overwhelming. Families that had worked hard for years to build a modest sense of security suddenly found themselves at the mercy of food banks and shelters. The middle class, once seen as the bedrock of the American dream, was hollowed out, with millions of families falling into poverty. In some cases, people never fully recovered, with long-term unemployment leading to chronic economic insecurity. Many individuals who lost their jobs during the recession struggled to find work for years, and when they did, it was often for lower wages without the benefits or stability they once had. But the impact wasn't just financial. It was emotional and psychological as well. The loss of homes and jobs created a sense of shame, failure, and hopelessness for many. Communities that were once tightly knit were fragmented, as people moved away in search of work or were displaced by foreclosure. This social dislocation had long-lasting effects, not just on individuals but on the broader fabric of society. One of the more profound psychological impacts of the crisis was the widespread loss of trust in financial institutions and the government. For years, many Americans had been told that the financial system was strong, that homeownership was the safest way to build wealth, and that their savings were secure. But the crisis revealed that these promises were built on shaky foundations. As people watched banks and financial institutions receive massive government bailouts while their own savings evaporated, a deep sense of betrayal set in. This erosion of trust wasn't limited to the U.S. In countries around the world, people began to question the very systems that had promised prosperity and security. The financial elites and government officials who were supposed to protect the economy seemed, to many, to have instead created and profited from the crisis. This loss of faith in institutions contributed to growing political unrest, anti-establishment sentiment, and in some cases, a surge in populism and protests. The psychological scars of the financial crisis were felt long after the economy began to recover. People who had lived through it, whether they lost a job, a home, or simply saw their retirement savings wiped out, carried a lingering fear of instability. Even as markets rebounded, many remained cautious about spending, investing, or trusting the financial system again. In the next segment, we'll explore how these social and psychological effects reverberated around the globe, triggering political and economic shifts that continue to shape the world today. As the 2008 financial crisis began in the U.S., it quickly spiraled into a global economic disaster, sending shockwaves through major economies across the world. While the U.S. bore the initial brunt of the collapse, other countries, particularly in Europe, soon found themselves facing deep recessions, financial instability, and growing debt crises. In this segment, we'll explore how the crisis affected key European economies and the long-term consequences of the policies that followed. At the heart of Europe's struggles were countries like Greece, Spain, and Italy. Before the crisis, these nations had experienced economic booms, with strong growth fueled by easy access to credit and low interest rates. However, as the U.S. housing bubble burst and the financial system unraveled, European banks, many of which had heavily invested in U.S. mortgage-backed securities, suffered massive losses. This undermined confidence in European financial markets and triggered economic slowdowns across the continent. In Greece, the situation was particularly dire. Years of government overspending and mismanagement had left the country with unsustainable levels of debt. When the global recession hit, Greece was suddenly unable to meet its debt obligations, sparking a sovereign debt crisis. By 2010, Greece's debt had reached crisis levels, and the country was forced to request emergency loans from the European Union and the International Monetary Fund to avoid default. These loans came with strict conditions, including harsh austerity measures aimed at reducing government spending and balancing the budget. The crisis wasn't limited to Greece. Spain and Italy, too, found themselves facing mounting debt and deep recessions. In Spain, the bursting of its own housing bubble, mirroring the U.S., led to massive unemployment, especially among young people, and a sharp economic downturn. Italy, with its already slow-growing economy and high public debt, was hit hard by the collapse in global demand and rising borrowing costs. Austerity measures became the go-to solution for many European governments, driven largely by pressure from the EU and the IMF. The idea was that by cutting government spending and raising taxes, these countries could reduce their deficits and regain the trust of financial markets. But the reality was far more painful. Austerity measures, while intended to stabilize economies, often made the recession worse. In countries like Greece, Spain, and Italy, deep cuts to public services, pensions, and government jobs pushed millions of people into poverty and further slowed economic growth. The social consequences were severe. Unemployment in these countries soared, reaching over 25% in Spain and Greece at the height of the crisis. Youth unemployment was even higher, creating a lost generation of young people who struggled to find work and build stable futures. As public anger grew, protests erupted across Europe, with citizens rallying against austerity, government corruption, and the perception that their governments were prioritizing the demands of international creditors over the needs of their own people. The debt crisis and the harsh economic measures that followed also exposed deeper structural flaws in the European Union, particularly the tension between richer northern countries, like Germany, and the struggling southern economies. Countries like Germany, which had stronger economies and lower debt levels, pushed for strict austerity and fiscal discipline, while countries like Greece and Spain, drowning in debt, pleaded for more support and flexibility. The European debt crisis ultimately led to years of political and economic turmoil. Greece, in particular, saw its economy shrink by nearly 25% over the course of the crisis, and it wasn't until 2018, nearly a decade later, that the country finally exited its bailout program. Even then, the scars of austerity, unemployment, and poverty lingered. Globally, the ripple effects of the European crisis were felt far beyond the continent. As Europe, one of the world's largest economic regions, entered a prolonged period of slow growth, global trade and investment suffered. This slowdown contributed to a sluggish global recovery in the years following the financial crisis, with many economies only regaining their pre-crisis levels of output and employment after several years. In the next segment, we'll explore the lessons learned from the crisis and the financial reforms that were introduced in an attempt to prevent another global economic disaster. After the dust settled from the 2008 financial crisis, it became clear that sweeping reforms were needed to prevent such a disaster from happening again. The collapse had exposed major flaws in the financial system: excessive risk-taking, a lack of oversight, and a regulatory framework that couldn't keep pace with the complexity of modern finance. In response, governments and regulators worldwide scrambled to enact new rules aimed at stabilizing the financial system. In this segment, we'll focus on the key reforms that were implemented, particularly in the U.S., through landmark legislation like the Dodd-Frank Act. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, was the centerpiece of America's post-crisis regulatory overhaul. It was designed to address the risky behaviors that led to the crisis and increase oversight of financial institutions. One of the most significant aspects of Dodd-Frank was the establishment of the Consumer Financial Protection Bureau, CFPB, an agency tasked with protecting consumers from abusive financial practices. Before the crisis, many Americans had been sold risky mortgage products they didn't fully understand, and the CFPB was created to ensure that consumers could no longer be so easily exploited by lenders. The CFPB was given broad authority to enforce regulations on financial products like mortgages, credit cards, and loans, ensuring transparency and fairness in the marketplace. For example, it required lenders to provide clearer information about loan terms and work to crack down on predatory lending practices. While controversial in some political circles, the CFPB was seen as a vital step in restoring trust between consumers and financial institutions. Beyond consumer protection, Dodd-Frank introduced a host of new regulations to increase oversight of risky financial products, such as derivatives, complex financial instruments that had played a major role in the crisis. Before 2008, derivatives like mortgage-backed securities and collateralized debt obligations were traded with little oversight, allowing banks and investors to take on massive, hidden risks. Dodd-Frank required these products to be traded on regulated exchanges and cleared through central clearinghouses, adding a layer of transparency and reducing the risk of unchecked speculation. Perhaps the most significant reform under Dodd-Frank was the requirement that banks hold more capital and undergo regular stress tests. One of the key lessons of the 2008 crisis was that many banks were dangerously undercapitalized. They simply didn't have enough financial reserves to absorb losses when the housing market collapsed. To address this, Dodd-Frank required banks, especially those deemed too big to fail, to maintain higher capital buffers. This meant that in the event of future financial turmoil, banks would be better equipped to withstand shocks without collapsing or needing government bailouts. In addition to capital requirements, banks were now subject to annual stress tests conducted by the Federal Reserve. These tests simulated various economic scenarios, like a sudden recession or a sharp decline in housing prices, to ensure that banks could survive under adverse conditions. If a bank failed a stress test, it would be required to take steps to shore up its finances, such as raising more capital or cutting back on risky lending. Dodd-Frank also introduced the Volcker Rule, which prohibited banks from engaging in certain types of speculative trading with their own money, a practice that had contributed to the crisis. The goal was to separate the riskier activities of investment banking from the more traditional and stable business of commercial banking, like taking deposits and making loans. These reforms marked a major shift in how the financial system was regulated. For the first time in decades, there was a clear push to rein in the power of the largest banks and ensure that they operated with more caution. While some critics argued that the regulations were too strict and would stifle economic growth, others believed that these measures were necessary to restore stability and prevent another catastrophic meltdown. Despite the sweeping nature of Dodd-Frank, debates over financial regulation continue to this day. Some argue that the law didn't go far enough in addressing systemic risks, while others have called for rolling back certain provisions, believing that too much regulation can hamper innovation and economic activity. In the next and final segment, we'll explore the broader lessons learned from the crisis and how our understanding of systemic risk has evolved in an interconnected global economy. As the dust settled after the 2008 crisis, one of the key lessons learned was the recognition of how deeply interconnected global financial markets truly are. The collapse of a single sector in the U.S. housing market triggered a chain reaction that reverberated across the globe, proving that no economy operates in isolation. This realization brought systemic risk to the forefront, understanding that vulnerabilities in one part of the financial system can quickly spread and destabilize the entire global economy. In response, regulators emphasized the need for stronger international cooperation, improved risk management, and coordinated oversight to prevent future crises from spreading so rapidly and devastatingly. However, a debate persists about whether the post-crisis reforms were truly sufficient. While measures like the Dodd-Frank Act and similar regulations around the world have undoubtedly increased oversight and reduced some risks, critics argue that these efforts didn't go far enough. Some believe that the financial sector remains too concentrated, with too big-to-fail institutions still posing a threat to global stability. Others suggest that the regulations are too complex, leaving loopholes that can be exploited. As the global financial system continues to evolve, so too must the conversation about managing systemic risk and ensuring the safeguards in place are robust enough to withstand the next potential crisis. In episodes 1 and 2, we've explored the full scope of the 2008 financial crisis, starting with the immediate collapse of the housing market and the unraveling of global financial institutions. We discussed the bank failures, the government's bailout efforts through TARP, and the Federal Reserve's actions to stabilize the economy. These episodes highlighted how interconnected global markets are and how quickly financial panic can spread across borders. We also examined the human and social costs of the crisis, as millions lost their homes, jobs, and sense of security. Rising unemployment, especially in the US and Europe, left long-lasting scars, and austerity measures deepened economic hardship in many countries. From the foreclosure crisis in the US to the debt crises in Greece and Spain, the ripple effects of the financial collapse were felt far and wide. Finally, we looked at the reforms implemented in the wake of the crisis, such as the Dodd-Frank Act and efforts to manage systemic risk. While these measures improved oversight and increased financial stability, debates continue about whether they were enough to prevent future crises. Join us next time as we dive deep into Project MKUltra.